Hi everybody, this is Thomas Wynn from Wynn Capital, and I'm going to review the fourth quarter. As you can see from this first slide, the market bounced back from the third quarter decline, and all asset classes in the stock area were up and bonds were mixed. There's a new feature on our report now which shows the best quarter and the worst quarter for all these asset classes. So for instance, US market was up 6.2 in the fourth quarter, and the average return on that is 1.7, and the best quarter ever was back in 09, 16% in a single quarter, and the worst was 08, the 22% decline. So for each of these asset classes, it's a really good way to get perspective. Each of the asset classes are volatile. It's the reason that we're diversified. We don't want to have quarterly concentrate investments in a single asset class, and that's why we diversify and spread out our investments. So I'm going to jump just to review. This next slide is the third quarter, and if you look at the third quarter, you'll see that the US market was down, international developed was down, emerging markets down huge, and bonds were up a little bit in the third quarter. And then if we go back, look at the scale of the declines in the international and emerging markets. And then they did recover, but just barely. The US recovered almost all of its losses, and the largest investment we have is in US large cap stocks because that's the biggest investment globally by proportion. But these two areas of Europe, which is developed foreign, and emerging markets, all China and Brazil, India, and all the other developing markets, they did not snap back. And then of course the bond market was mixed. So even though we snapped back, we didn't snap back as much because many of our asset classes didn't come back. So this is the quarter, the news headlines and the path of the market, and you can always pause and take a look at that. And also new for this report is we're also showing from the beginning of the year, instead of just a quarterly headline review, this shows the path of the whole year and the news that the market reacted to. And then this is an even longer, all the way back from 2000. This is the path of the market, and just a snapshot to give us perspective from the quarter to the year to a very long period, give us perspective about what the market has been doing. Then we break down in the entire world. We'll take a look at all the asset classes, a little more detail, and real estate and US large cap was leading, and the worst performing were emerging markets, which continue to struggle. If we concentrate on US stocks, there's a couple things. All the asset classes were up, but there was really wide divergence from the large cap all the way down to the small cap between how well each of these categories did. And then this square captures the one-year returns, which were negative in most of the categories, and very wide divergence between the best performing sector and the worst performing sector, which is kind of a feature of this particular market, is some non-correlating. Usually these things move together more or less, but over the past year this has been a really wide divergence. And if you guessed right and concentrated all your assets in large cap US and shorted or stayed away from the worst performing sector, you outperformed by a large amount. And if you're diversified, you, like us, your returns are an average of those asset classes. And then in the international developed, again, really big divergence between the best performing sector for the last year and the worst performing sector. All categories were up with pretty wide divergence between the best and the worst. And then in emerging markets, which has had a horrible year, this group is volatile. It's only 10% of most portfolios, 100%, and a much smaller fraction in many of our portfolios. And we're looking at this closely, trying to decide when and how to either get back to neutral allocation or even overweighted, but it's one of the many conversations we have all the time. But when it does well, it has fantastic returns because it's a risky asset, and then when it does poor, it does worse than all the other asset classes. In the countries, this slide was interesting to me. We do not currently invest in specific countries. That's currently beyond our abilities right now to do the due diligence, but it's one of the many aspirations we have. But we do follow these countries, and if we decided there was a very compelling reason, we might overweight a country using ETFs or some other vehicle. But I was struck by the best performing country, New Zealand, up 20%, the worst, Greece, and the big difference between the two. Like all other asset classes, if you guess right, you're rewarded. If you guess wrong, you can underperform by huge amounts. So we stayed diversified to avoid that. And then in commodities, everyone knows commodities. Oil's getting all the headlines, but many commodities are getting crushed, and they had a particularly difficult quarter, and many stocks, are attached to these commodity prices. And also the emerging markets are really commodity-based economies in many cases, and they're suffering from the sharp decline in commodities. We are looking at oil. We have not really done a firm-wide oil overweighting, but we're looking at it carefully, and that could be coming in the coming weeks or months. And then fixed income. Fixed income, ever since the 2008 decline, have been very, very depressed relative to historical levels. That is a tremendous drag on our portfolios, as our bond allocation for a typical 60% stock, 40% bond is getting very low returns. And we're not going out very far into riskier and riskier assets, as many individuals are, into master limited partnerships or commodities or real estate. In general, we're sticking with high value investments in the fixed income area. And so our returns are being dragged down by low rates. The Fed, of course, did raise rates. It didn't have much effect on the market. It was already priced in, as most news is already priced in. But you can see that the 3-year returns for fixed income are very depressed, and returns over the 1 year were very depressed. This is also just a quick look at, as we always look at, people that are very aggressively invested make great returns during bull markets. They have the best return. And when you're more conservative, you have lower returns but less risk. And just over the last year was a tough year, with some sectors really getting hammered and many sectors relatively flat. And those are the 1-year returns for these types of portfolios, from aggressive to conservative. And this is a short article by DFA about the rise in interest rates, how the interest rates really rose before the Fed did anything, but they're still very, very depressed. That is it for the fourth quarter review, and I hope you find it helpful. And if you have any questions, you can give us a call anytime. Thanks a lot. Bye-bye.